Back in February 2011, something truly bizarre happened in Hong Kong. A silver dealer posted a buy price of $120 per ounce. Now, at that very same hour, the global spot price for silver was $77. That's not a typo. Think about it this way. If you walked into a gas station and they wanted $8 a gallon when the station across the street was charging $5, you'd laugh and drive away. They stood in long lines. Some even flew in from other countries just to buy. This isn't really a story about silver. It's a story about the moment when the market price and the real price stop meaning the same thing. Let me show you something. Go ahead, pull out your phone and check the silver spot price. Let's just say it's $28 an ounce. A clean, simple number, that's what the market says silver is worth. The cheapest 1-ounce silver coin you'll find online is probably $32, maybe $33. And that's before shipping. Here's what makes this so strange. Silver is some rare, artisanal product. It's a globally traded industrial metal with a ticker symbol. $1 million contracts change hands electronically every day. The price is supposed to be the price, a crack in the system that most people just ignored. But if you understand why that crack formed, you understand something much bigger about our markets, about scarcity, and about the massive gap between and what something costs on a screen versus what you actually pay to hold it in your hand. So, let's break down how silver actually moves through the world. The first is the paper market. This is where you find futures contracts, ETFs, and all sorts of derivatives. This is where that $77 price lived back in 2011. It's where hedge funds and banks trade silver they will never, ever touch. They're trading promises, they're trading contracts that usually just settle in cash. The metal itself almost never moves. It's really just accounting, but this market is enormous. We're talking trillions of dollars in notional value. Then there's the second market, the physical market. This is the world of actual metal. Coins, bars, rounds. This is where dealers operate. It's where you and I would buy if we wanted to hold physical silver. Under normal conditions, these two markets stay connected. A process called arbitrage keeps them honest. If physical silver suddenly costs way more than paper silver, some clever trader buys a paper contract, demands delivery of the physical metal, and then sells that metal for a nice profit. That constant pressure is supposed to keep the prices aligned. For months, China had been buying, not just trading buying. They were taking delivery, moving tons of physical metal out of Western vaults and into Chinese hands. India was doing the same. By early 2011, the Shanghai Gold Exchange was reporting that its physical silver inventories were falling off a cliff. At the same time, investment demand in the West went parabolic. People who'd never thought about precious metals before were suddenly walking into coin shops. Silver hit $50 an ounce in April 2011, then it corrected down to the mid-30s. It was volatile, scary, and exciting all at once. But here's the key. Even as the paper price dropped from its peak, the demand for physical metal didn't. The U.S. Mint actually had to suspend sales of its popular Silver Eagle coins in 2011 simply because they couldn't produce them fast enough. And when supply disappears while demand stays high, the price you pay in the real world stops caring what the futures market says. That dealer in Hong Kong wasn't just price gouging. He was clearing a market. He had the metal. People wanted it desperately. Now, here's where it gets really interesting. Back in 1980, the Hunt brothers famously tried to corner the silver market. They failed spectacularly, lost billions, and went bankrupt. The lesson everyone supposedly learned was that you can't corner a modern commodity market. It's too big, too liquid, too transparent. But the 2011 premium spike wasn't a corner. It was a supply shock that the futures market was completely blind to. Paper markets trade incredible volume. They trade contracts equal to 5 times the annual global silver production, maybe even more. But the moment a significant number of people start asking for actual delivery, the whole system starts to convulse. In 2011, The COMEX, the main commodities exchange in New York, had a registered silver inventory of around 40 million ounces. That sounds like a lot, right? Except the daily trading volume was 3 times that much, every single day. If even 5% of contract holders had demanded delivery, the whole thing would have seized up. They didn't. Most traders never do. But enough people in Asia did that the physical market completely fractured away from the paper market. Now, look at the math from the dealer's perspective. You're in Hong Kong. You have 500 ounces of physical silver. The spot price is now 77. You're up on your investment, but your supplier is completely out. The mint is backordered for 8 weeks. They know that if they don't buy from you today, they might not find metal anywhere else tomorrow. What do you charge? You charge what it takes to clear the line. You charge until the last beer stops bidding. In this case, that number ended up being $120. It was transparent. Everyone in that line knew the spot price, and they paid anyway. Because the spot price assumes instant liquidity. The financial media lost its mind in 2011. Headlines screamed, "Silver to 100. Silver to 200. Coin dealers were on TV explaining why you needed to protect yourself from currency collapse. And yet, silver peaked at $49, then it crashed. So, was the Hong Kong premium hysteria? Panic buying? Partly? Yes, but not entirely. The premium reflected something very real, a complete breakdown in the delivery mechanism. That's not supposed to happen. The fact that it did means the system was far more fragile than all the pricing models assumed. And here's the uncomfortable part. It's happening again. Not at the same intensity, not yet, but the premiums are back. In 2020, during the pandemic, silver premiums spiked to $10 over the spot price. In 2023, shortages hit again. Dealers are quoting 4-week delays. Mints are rationing their output. The spot price sits there, calm and collected, $28, $29. Meanwhile, go try to buy a tube of Silver Eagles. You're paying $34, $35 an ounce. That's a 20% premium on a commodity. The gap is back. It's smaller than it was in 2011, but it's there. And every time that gap widens, it's telling you the same thing. The price you see on the screen isn't the price that actually matters. This isn't just about silver. It's about any market where paper assets are supposed to represent physical things. Oil, gold, even shares of stock. When you think about it, most stock trading today is synthetic. It's done through ETFs, derivatives, and contracts for difference. Very little actual share delivery happens anymore, and that's fine, until it's not. What the 2011 silver spike revealed is that our system for price discovery works perfectly, right up until the moment everyone wants the actual thing. Then the models break, then premiums explode. Then people realize they were trading symbols, not substance. Central banks know this. That's why they hold physical gold, not gold ETFs. That's why countries like China and Russia have been accumulating physical metal, not paper contracts. They understand the difference between a claim and a thing. For decades, the financial system has gotten more and more abstract, more leveraged, more disconnected from the physical world. Terms like rehypothecation, fractional reserves, and naked shorts aren't conspiracy theories. They're features of the system. They add liquidity and smooth out markets. But they also create intense pressure points, and when those points crack, the people holding the paper promises find out what they're really worth. $77 bought you a contract in 2011. $120 bought you metal. That $43 difference was the cost of certainty. So here's the question nobody seems to want to answer. If a global market can't even deliver physical silver at its own spot price during a relatively minor demand surge, what happens when the demand isn't minor? What happens when a real currency crisis hits? When inflation stops being transitory? When faith in our institutions cracks for real? Not just on some fringe forums, but in corporate boardrooms and central banks. The paper markets will still function. Numbers will still update on the screens. Analysts will still come on TV and explain why the price is rational. But somewhere, in some city, a dealer will post a number that just doesn't match. And people will pay it, because in that moment, they'll understand something the models never could. The price of a thing isn't what the market says it's worth. It's what you pay when you absolutely need it and you can't wait. That Hong Kong dealer wasn't wrong in 2011. The market was. He had silver, the market had a number, and only one of those was real. The next time that gap opens, it might not stop at $43. It might not close at all. Thanks for watching. If you found this interesting, consider subscribing for more deep dives into how our world really works. See you next time.